Well, hello everyone. Welcome to the REI Rockstar Podcast. I'm your host, Nick Bauer. We got John on the call. How are you doing, John?
Good, Nick. How about you? Thanks for having
I'm
me.
doing fantastic. Can you hear me okay?
Yeah, I can hear you okay.
Awesome. Good audio check. Well, guys, today, thanks for tuning in. We're going to be talking about self-directed IRAs and what that is, what you can do with it, and how to make money and how to invest in real estate with a self-directed IRA. We have an expert on the line here today. Really excited to have him on. But before we get to him, I just want to do a quick shout out to our show sponsors. We have Michael Sewell with the Sewell Law Firm, Rebecca Meyer with Insight Title. We got graphic connections for direct mailing, and of course, the one, the only Lawrence Hopkins with Longhorn Investments, Longhorn Financial. So quick shout out to them. Thank you for supporting the show, and thank you for bringing the REI Rockstar Podcast to fruition. So, John, you're from Cleveland.
Yep.
Were you born and raised?
Born and raised in Cleveland.
And so you had that polar vortex come down, and you were affected by that as well.
Yeah. We're used to it though. We're right on Lake Erie, so we get it every year. We're used to it.
Cool. All right. Well, let's talk some real estate here. You do
Sure.
self-directed IRAs with Equity Trust, and you're a retail sales manager, and that makes it sound like you should be on that TV show, The Office. And it's not a very sexy title, but it's a very powerful title. How long have you been doing this, and why do you do it?
Yeah. So I've been in the business for 10 years, and I've been around real estate for 15 years. And when I came to the organization about 10 years ago, and I started to lead up a lot of our business development efforts, one of the things I started doing and working in close connection with the Desich family. They're the owners of the business. Dick Desich, he's widely known as the pioneer of the self-directed IRA industry, took the company from 22 investors back in 1983 when we got an IRS determination letter to over 130,000 customers and over $13 billion in assets under custody. So when I came aboard and sort of they brought me in under their wing, one of the things that I was tasked at doing is going out and really sort of spreading the word on how to use the self-directed IRA to invest in real estate, notes, private equity, other alternative assets in a tax-free, in some instances, a totally tax-free environment. And so that's how I got started. And, conferences, seminars, trade shows. I host a one-day conference on Saturdays all across the country. I know we got one coming up on a Saturday that we're going to be doing for you folks, which is going to be really, really exciting. Yep. And radio shows and other things. The idea is you're not going to see this stuff commercialized. You're not going to see advertisements on how to buy real estate with a self-directed IRA. So our organization, our business is just 100%, I'll call it grit, 100% just boots on the ground, educating people on how they can use IRAs and 401k rollovers and other self-directed tax-advantaged vehicles to buy and sell real estate or lend money to investors and do other types of unique non-stock market related type of transactions.
Absolutely. So, we've some of the folks in our organization have been, we've been around before, or been around the block, and they get the concept and they've been exposed to it. They probably are already doing it themselves. But for someone brand new, never heard of this topic before, you kind of explain what it is, but how can that be beneficial to a real estate investor who maybe have never heard about this before? How can they take advantage of this vehicle?
Yep, absolutely. And I'll speak in terms of the folks that come to our organization and they seek out our education and our guidance. So the first type of individual is oftentimes the individual that has an existing 401k with a previous employer or a 403b or a pension or maybe an IRA that's been investing in, let's say, a mutual fund lineup. And they're disenchanted with the stock market. They no longer want to be tied to stock market related investment options, and they want to invest in real estate. Now, some of these people have a lot of experience. They've been doing it for many years, flipping houses, buying rentals, cash flowing, and they want to say, hey, now I want to do the same things that I've been doing, and I have a historical track record with these types of investment options, and I want to do them in my IRA. And oh, by the way, it's tax-free or tax-deferred in my retirement plan. So we have those types of individuals. They're looking for, if you will, diversification. In summary, they're looking for diversification. Some have experience, some don't have any experience. They're doing it for the first time with their IRA. And then the second type of individual is the individual that may not have an existing IRA, maybe starting from scratch, and they want to put a $500 contribution into a Roth IRA, for example. We had a lady in Cincinnati who set up a Roth IRA in 2014 with $500, and she grew it to nearly $50,000, almost 100% tax-free in 12 months. And that was through a series of real estate transactions. They were creative, financed real estate transactions, but she was able to achieve that. So, those are the two types of individuals that sort of seek out our guidance: the individual that ultimately is looking for diversification, and the individual that's looking to create wealth and grow wealth in a tax-advantaged environment. And what you get with that, ultimately, the byproduct is leveraging compounding interest in the absence of taxation. So you're taking compounding interest, you're taking out the variable of taxation, which can start to increase your yields over long periods of time.
Absolutely. Yeah. When I've never actually really thought about that, but I mean, that's why people obviously do the self-directed IRA strategy to save on taxes. But I never thought about the return calculating so much quicker without, might be kind of a dumb realization that I just realized here, but obviously you grow quicker if you don't have to pay taxes. But when you figure in compounding interest without having to take out every year for taxes, I guess maybe that's the way you just put it. I think maybe learn something new every day in this business, but just the way you put that was like, oh, okay, that's, I never thought about it that way. I just, grows tax free or tax deferred, but interesting.
And to give you an example,
different perspective every day.
Yeah, and to give you an example, Nick, and for the audience members, in 2017, we named an investor by the name of Brian from Tennessee our Investor of the Year. We do this award every year. We have hundreds of folks that will send case studies into us, and they want to be the Investor of the Year, and they get a free account for life. So this gentleman, Brian, to make a long story short, he took 3 accounts on his first deal. 3 accounts, he combined them together. And these were actually Coverdell education savings accounts, which is something that goes even beyond IRAs, but it's a tax-exempt savings vessel. So he took these 3 tax-free investment accounts, and he bought a vacant property for $8,000. So it was a vacant lot, $8,000 purchase with these 3 investment accounts for his 3 children. And he sold it for $60,000 and made a $58,000 tax-free profit. That's $58,000 that's going to go towards his children's college tuition, 100% tax-free. That's $58,000 that is not going to find its way on his 1040, his Schedule C or 1040, and pay ordinary income taxes on short-term capital gains tax. It's sheltered in the tax-exempt investment accounts. And then he went on to do another deal where he combined 5 accounts. He had his 2 Roth IRAs for him and his wife, his 3 children's Coverdell education savings accounts, bought a vacant lot, all in purchase, and then they had some zoning that they needed to do, some planning with the city, fees, etc. They were $120,000 all in. They sold it for $200,000. They made an $80,000 tax-free profit. So that's just to put into context for audience members, some of the things that could be done with the self-directed IRA. But whether someone's looking to flip houses in their IRA, they're looking to buy and hold, they're looking to lend money to other real estate investors, like maybe a 12-month or 18-month or 24-month term loan, a flipper loan, I'll call it. Those are all things that can be done inside of a self-directed IRA. The most common question I get from folks is, well, John, if I take the money out of the IRA to buy a property or make a loan to another investor, aren't there tax consequences? Aren't there penalties? And there's not. A self-directed IRA to invest in real estate, fundamentally, instrumentally, it's really no different than buying a stock or a mutual fund. When you buy a stock, cash leaves the account. In return for that cash is a stock certificate. If I go out and buy a house with my IRA and I rent it out, same concept. Cash leaves the account. In return for that cash is a deed to the property. And now my IRA pays for the fix-up and repairs if needed. And then all my cash flow goes back into my IRA. And the beauty of it is if it's a Roth IRA in particular, it could be any IRA, but if it's a Roth IRA in particular, you can create tax-free cash flow. I know a gentleman down in North Carolina, coincidentally his name's Brian as well. He'll have 40 properties in about 3 to 4 years. He's going to have 40 properties in his Roth IRA producing $200,000 in net income a year. He's already got 16 now. And so during his retirement years, he'll be able to live off of $200,000. That's never going to hit his ordinary income as taxable income. It's 100% tax-free. And all the assets in his Roth are tax-free. And when he passes away and leaves it to his children, they don't pay any taxes on it either. So I'm getting a little bit into the more gritty aspects of things here, but the long and short of it is there's some significant advantages with using these IRA accounts, and most of that has to do with the tax sheltered treatment associated with them.
Well, and you can tell your passion for it. I mean, what's funny is a lot of times we'll have what I'm noticing is we'll have people on the podcast as a guest, and we'll take a topic that their niche is or their area of expertise is, and then I can't get a word in edgewise because they're just so passionate about what they're talking about. So you can talk for as long as you want, man. We got time. I think that's awesome. And honestly, I think stories is what tells is what really helps people relate to how something, because I mean, even if someone's heard the term self-directed IRA before and they know what it is, maybe they don't have a self-directed IRA, or maybe they don't have a 401k that they can roll over into, or maybe they don't have any type of savings account, so they didn't think it was for them. But you just told that story of that one person that started with $500 and grew it up, and maybe that could help inspire someone else to do that. So I mean, yeah, stories can definitely help, and I love hearing stories about real estate to begin with. But in order to make for just a good conversation, I think stories can be a great way to do that. So absolutely. So what if you've got like a 401k, but you don't have a self-directed IRA? Am I out of luck?
Not necessarily. If it's a 401k with a previous employer, it's a done deal. You can essentially roll that money over into a self-directed IRA, and it's a simple process. When you work with a custodian like Equity Trust, and I'll be agnostic here, we all operate in a very similar fashion. But if you were to work with our company, we would open an account for you, and that's a simple 24-hour process. And then you would instruct your 401k provider to initiate a rollover. And that's important there. You're initiating a direct rollover, and that money, let's say it was $100,000. That $100,000 is going to move over into your self-directed IRA. No taxes or penalties, of course. And then you could begin accessing that money and directing it for your real estate investments or your private lending investments that you're looking to do, or if you want to buy a rental property. All of those are things that you can do. Now, what's important fundamentally to understand for everyone is that when you're working with a true self-directed IRA custodian, Equity Trust being one of many, of course, in the field, is that you're working with a different type of financial institution than what most people are accustomed to. Most people are accustomed to the large clearing firms or wirehouses where you open an IRA with them, you put money into the account, or you roll money into the account, and then sometimes you have a financial advisor, sometimes you get like a robo-advisor, but ultimately you can only invest in stocks and mutual funds and traditional assets. And not that that's a bad thing. There are some people that's all they're going to ever do, and that's okay. But for the audiences that I work with and I coach and I mentor are the audiences that say, hey, I'm not interested in the 4.5% to 5% yield that I've made over the last 10 to 15 years. I'm interested in the 12, 13, 14, 20% yields that I've been making in real estate. Of course, past performance isn't predictive of future results, et cetera, and everybody has to do their own due diligence, and we're just a passive custodian that allows people to do this, and that's important for folks to understand that we're not here to give legal advice or tax advice, but relatively speaking, in my experience, the folks that come to us are coming to us because of the opportunity of them being able to take control, direct their funds into real estate in which they feel more confident in, and they feel they can drive a much higher rate of return compared to what they were doing before in the stock market. So that's the type of financial institution that we are. We're really no different than the banks and the big clearing houses. It's just we're set up and have the infrastructure and the technology stack to allow someone to go online and say, Equity Trust, I need you to send $20,000 to XYZ Title Company to buy this property, and then we push that money out and we facilitate that transaction.
Right. So they're not going to call you up and say, hey, John, I've got some money. Where do I put it?
That's
they're
correct.
going to call you up and say, I would like to start a self-directed IRA, or I'd like to do a 401k rollover because I have some investments that I have my eye on.
That's correct. And with the 401k, the only situation that could come up where you couldn't move it is if you were still working for the company and you were under the qualified retirement age of 59 and a half, you likely can't move that over. So you'd have to leave that employer or wait till you retire, turn 59 and a half to move it over. But if it's an IRA, if it's a 403B with a previous employer, a thrift savings plan for those that work for the federal government, just about any retirement plan, qualified or IRA, you can move into a self-directed IRA environment without any taxes or penalties and then deploy that cash for real estate investments.
So let's say someone has a self-directed IRA that they set up with you, and they put maybe they rolled over a 401k from a past employer. Say they have $20,000 in there, but there's an $80,000 property that they have their eye on. Do they have to wait until they've got 80,000 cash value to be able to pay cash, or are there any options?
Yeah, there are options. So we find a lot of folks that are in situations like that will partner their IRA money with their non-IRA money, or maybe partner their IRA money with a third-party investor. And those are two distinctly separate types of strategies. So let's say, for instance, an investor only has $20,000, but they have a lot of cash in the bank. And so they can put in $20,000 with their IRA, and let's call it an $80,000 all-in purchase and rehab. So they put in $20,000 with their IRA, and then they put in $60,000 personally. Okay. So in that particular scenario, that would, if you do the math, it'd be right around a third, right? So a third of the property would be owned by the IRA, and the other 2/3 would be owned by that individual personally. And so they would actually enter into a tenants in common arrangement, is what that's referred to, when buying the property. They would have their IRA listed as a third owner and themselves listed, or their LLC listed as a 2/3 owner. And then going forward, all of their profits would flow a third, 2/3. And that's important because if an individual to their IRA is partnering on a deal like that, they cannot disproportionately benefit, meaning they couldn't take 100% of the profits and stuff it into the tax-exempt environment IRA.
Right.
They would need to make sure that everything flows proportionally, because the IRS or the government defines an individual account holder to their IRA as what they call a disqualified person. And this gets in a little bit to the legalese of IRAs, but ultimately what audience members need to know is things just have to flow proportionally. That being said, Nick, let's use an example of you and I. And this is where, folks going to meetup groups and meeting other investors out in the field can be beneficial. Nick, you and I are not disqualified persons, for the audience members that couldn't tell already. And so we could partner on a deal, and we can negotiate a joint venture at whatever percentage we want. So let's say I came in with $60,000 with my IRA money, and you put in $20,000 with your IRA, and you wanted to do a 50-50 split because you were the one that was finding the deal and sort of orchestrating the entire transaction. And let's say we flipped that house for $110,000, and after closing costs made a $25,000 profit. $12,500 goes back to your IRA, and $12,500 comes back to me. I'm happy because I get a good return on investment as a passive investor, and your Roth IRA just went from $20,000 to $32,500, and that income is tax-free in the account. So a lot of different ways you could carve it up. I've seen investors use up to 10 IRAs and investment accounts on one deal. And that could be a private loan, or it could be a property acquisition.
Excellent. So you're coming to town.
We are. That is coming up. And I wish I could tell audience members the date if I knew it off the top of my head.
We'll pop it up on the screen, but it's the first weekend in March, I believe. You're coming to speak at a 3-day Find and Fund seminar.
Yep.
Excuse me. And I'm excited to have you there. So that's going to be awesome. That's going to be a tough weekend. I was going to say maybe I could take you out fishing on the Mississippi River. But I'm going to be doing real estate all weekend, so probably not. Maybe some other time when you come in.
Yeah.
But, that's awesome, man. What else? You're also a real estate investor yourself, so you do deals in Cleveland or out of town, or where do you buy properties at?
Yeah, mostly in Cleveland. And my strategy with my self-directed accounts is all on the lending side. So I originate loans to rehabbers. So my self-directed retirement accounts make loans to investors to fix and flip properties. And a lot of the houses that we're doing, I don't have ownership in the house, but I have a promissory note in my Roth account and a mortgage, a first lien mortgage.
Yep.
And so I've worked with an attorney. That attorney has drafted documentation for me to do these types of transactions. And that's always important to mention to audience members, that it's important to have an attorney, to have these other financial professionals. We're a passive custodian. We can't do that. So we encourage folks to do that. But I have that attorney, and I make loans secured by properties, and the interest income that comes back in is tax-free in my Roth IRA. And so if I can do a loan and charge 8%, let's say, and it pays back in 4 months, and then I can do another loan that pays, and when I say 8%, I don't mean per annum, I mean 8% flat, and then I could do another loan at 8%, that's now I'm starting to annualize myself at 16% or greater. So if I can increase the velocity of my money, and I can do a lot of these loans in and out, and I have a pipeline of deals lined up, then I could start to increase my yield significantly, and it's all, of course, tax-free in the Roth account. And so that's my strategy. We do a lot of foreclosure properties, so I'm lending on foreclosure properties, which have a lot of interesting quirks, and there's can be additional risks associated with it, but you learn how to navigate the county recorders and get your recorded mortgages and go through that process. And ultimately, it's just all about going out and meeting more investors and finding folks that are looking for private money and looking for deals, and ultimately being able to bring the two together. So that's been my primary focus in managing my own portfolio. It's one of the things that I do talk about quite a bit when we do workshops. One that's going to be coming up here. We talk about the process to use an IRA to make a loan to an investor. We don't give, again, legal advice or tax advice, but we show them that process. We show people the process of if they want to buy a rental property with their IRA and cash flow that income back into the IRA tax exempt. We show them how to do that. And so it's been really exciting over the last 10 years. I never did a real estate deal until I came to the company, and that was kind of the catalyst. I'd been around real estate, working for a commercial real estate company, doing a lot of construction work, property management work. So I'd always been around real estate, but never been in real estate. Now I finally feel like I'm sort of in real estate, and that's all I do. I work with investors that want to do deals, that want to find opportunities, and want to learn how to use their IRA to do that.
Awesome, man. I can't wait to have you in first weekend of March.
Yeah.
Thanks for joining us for a few minutes here and sharing a little bit about what you do and how you can help people, and what self-directed IRAs are, and how you can use that as a really awesome way to grow real estate without having to pay Uncle Sam. I know there's a lot of people out there that don't like to pay Uncle Sam, so hopefully this helps them out. So
I'm looking forward to it, Nick. I appreciate the time today.
Yeah, it's been awesome. Thanks, man. I really appreciate it. I look forward to seeing you in March. Guys, any questions, comments, or concerns, just put them below in the comments section if you're watching on YouTube. But this has been another segment for the REI Rockstar Podcast. I've been your host, Nick. We've had John on the line here. So, John, thanks so much. Really appreciate it.
Thank you, Nick. Appreciate it.
Nick signing off. We'll see you at the top or from the top. Talk to you soon.